Welcome to my channel. I'm Scott, and in this video I'm going to walk you through the process of valuing ONEOK stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. Let's get started with the model. This is a large cap company, 41 billion market cap. They're trading at $70 a share and they have 583 million shares outstanding. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. Their free cash flow looks great. It was negative in 2020, up to 1.8 billion in 2021, way up to 2.6 billion in the trailing 12 months. Net income is the profit or loss on the income statement. It's revenue minus expenses. That also looks really good, growing from 600 million to 2.5 billion. Revenue is sales for the company, and that goes from 8.5 billion to 22 billion. It does drop in the trailing 12 months to 17 billion. Pretty interesting because their net income and free cash flow are much higher with lower revenue. Their revenue nearly doubled from 2020 to 2021, up 35% into 2022, but down 22% into the trailing 12 months. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 4, that's 40 billion. We discounted the numbers back to today using the weighted average cost of capital. We get a value of the company of $36 billion. We divide that by 583 million shares. And we get a calculated stock price of $62. They're trading at $70, so they're trading at a 13% premium. It's a sell according to the model. Here's their stock price the last 5 years, the blue line. The red line is the price of Brent crude. You can see how they track each other. It's really close. This stock is up 11% in 5 years. Brent crude is up 25%. But they pay a dividend, as you can see here. So if you add in the dividend, it's probably up almost exactly what Brent crude is up, 25%. From mid-2019 to mid-2021, they tracked each other almost identically. Then Brent crude went up a lot more than this stock. But you can see how inflated the price of Brent crude was, and it came back down a lot from the peak, closing the gap between the two stocks. There are 50 companies in the same industry as ONEOK, and if they have a number in red, they're worse than the median. If they have a number in blue, they're better. They spend 1.3 billion in capex. Enbridge spends the most. Most companies in this industry are pretty leveraged because a lot of them are MLPs, master limited partnerships, which means they have to give at least 90% of their earnings back to the investors in the form of a dividend. So they don't have much money left over to grow the business, so they take on debt. They pay a pretty good dividend, 5.4%, but that's a good amount lower than the median. Look at ET, 11%. I bought ET about 2 years ago, and if you include the dividends, I'm up about 100%. They generate 2.6 billion of free cash flow, a lot lower than Cheniere, 7.7 billion. They're number one. They rank 5th in market cap. It's number 9 here, but I just didn't sort it correctly. The giant Canadian midstream company is number 1, 72 billion. All their price multiples are worse than the median, so they do appear overvalued like my model says. They generate lots of revenue, 17 billion. ET is number 1 by far, and their 5-year annual revenue growth rate is only 6%. Look at Antero, 89%. ET is pretty good at 9%. Buy ET, it's a great stock. This is a great stock if you like a dividend. 25 straight years of dividend growth, up to $3.82 a share. Let's look at their most recent 10Q. This is from 9/30/2023. Let's start off with their income statement. Revenue is down a lot. It was 5.9 billion in the third quarter of 2022. It's 4.2 billion currently. Most of their revenue is commodity sales, 3.8 billion. Services, 400 million. Let's see if they give a different breakdown of this number. Of the 4.2 billion of revenue, 3.4 billion is NGL and condensate sales. NGL is natural gas liquids. 280 million from residue natural gas. Gathering, processing, and exchange services, 186 million. Transportation and storage, 188 million. Below revenue is the cost of revenue. That's 2.8 billion. 300 million of operations and maintenance. 177 million of depreciation and amortization. It's interesting to see that their operating income is higher. It was 700 million, now it's 739 million. With lower revenue, higher operating income. And their net income is also higher, $430 million to $450 million. Earnings per share is 99 cents, which is really close to $1. This implies their net income is almost equal to their shares outstanding, 454 million, 457 million. They did increase their shares outstanding from 448 million last year to 457 million this year. Let's look at their balance sheet. Current assets of $3.2 billion, current liabilities of $3.3 billion, so their current ratio is below 1. So they may need to add some debt to get through the next 12 months. They have lots of PP&E, $32 billion. Their PP&E is mainly pipeline-related equipment, storage tanks, as well as processing equipment. They have $1.8 billion of investments in unconsolidated affiliates, $5.7 billion of goodwill. Most of that goodwill is acquisitions of companies in refined products and crude, $5.2 billion. If you follow this company, you probably remember that they acquired Magellan. In September 2023, they completed their merger with Magellan. Each common unit of Magellan was exchanged for 0.667 shares of ONEOK common stock. Also, $25 of cash. So if you own one share of Magellan stock before the merger, then you received 2/3 of one share of ONEOK stock plus $25 of cash. You can see their total assets went up a lot with the Magellan merger. $24 billion at the end of 2022. It's currently $44 billion. Their big liability by far is long-term debt. That's a lot of debt, $21.4 billion. You can see it almost doubled since last year because of the Magellan merger. Here's a list of their debt in this column. They have $500 million of debt that matures this year in September. The interest rate is 2.75%. $1.5 billion of debt matures in 2023, 6% interest rate. And you can see how long this list is, so much debt. Here's their total long-term debt, $21.45 billion. When you take their assets minus liabilities, you get their equity of $16 billion. They raised $16.3 billion from selling their business, selling stock. They profited $737 million from running their business, and they bought back almost $700 million of their own stock. Treasury stock is a contra equity account. It brings down your equity balance. Let's look at a statement of cash flows. This is for the trailing 9 months. In 2023, they had operating cash flow of $2.9 billion. Last year, it was $1.9 billion. The way you calculate operating cash flow, you start with your net income of $2 billion. We add back the non-cash items on the income statement, depreciation, amortization, $500 million. On the income statement, they pass through a gain in equity earnings. We minus that out here. But we add the dividends they received on those equity earnings, $134 million. They pass through a loss of $599 million in deferred income taxes. We add that back here. And remember the Medford situation? There was a gain of $779 million on the income statement. We subtract that out here. And they received $500 million in proceeds, which is a cash item. If you're not too familiar with the Medford incident, I'll summarize it real quick. In July of 2022, a fire occurred in one of their facilities in Oklahoma. It was a natural gas liquids fractionation facility. They had to settle claims with their insurance company for physical damage. Here's a picture of the liquid explosion at Medford. Residents within 2 miles had to evacuate. The reason they paid out so much in claims is because there was property damage at people's homes and businesses. Let's look at their investing section. They spent $1 billion in CapEx, a little more than last year. They paid out $5 billion for the acquisition of Magellan. If they acquired Magellan for $10 billion, an all-stock deal, then you wouldn't see anything on a statement of cash flows, because a statement of cash flows follows cash. But let's say they acquired Magellan for $10 billion, all cash deal, then you would see $10 billion here. Sometimes it could be part cash, part stock. The price of the acquisition was for $19 billion. So this means they paid $14 billion in stock, $5 billion in cash. In their financing section, they spent $1.3 billion in dividends. They added $5 billion of debt, and they paid $1 billion of debt. Let's look at them on Simply Wall Street. Its last price, $70, $41 billion market cap. Flat the past week, flat the past year. ONEOK engages in gathering, processing, fractionation, storage, transportation, and marketing of natural gas and natural gas liquids in the U.S. In the oil and gas industry, fractionation is a separation process. It's the process of separating the oil. They boil off the different hydrocarbons one by one. Natural gas is mainly made of hydrogen, while gasoline is composed of carbon compounds. So the point is, natural gas is supposed to emit less harmful emissions, such as carbon dioxide and carbon monoxide. Natural gas liquids are different than natural gas. It can be really valuable to separate the natural gas liquids. Natural gas liquids are used for lots of things: cooking, gas, heating, plastics. They operate through 4 segments: natural gas gathering and processing, NGL, natural gas pipelines, and refined products and crude. They own natural gas gathering pipelines and processing plants in the Mid-Continent and Rocky Mountain regions. They also provide midstream services to producers of NGLs. They own NGL gathering and distribution pipelines in Oklahoma, Kansas, Texas, New Mexico, Montana, North Dakota, Wyoming, and Colorado. They have terminal and storage facilities in Kansas, Missouri, Nebraska, Iowa, and Illinois. NGL distribution pipelines in Kansas, Missouri, Nebraska, Iowa, Illinois, and Indiana. They also transport refined petroleum products, including unleaded gasoline and diesel, from Kansas to Iowa, as well as owning and operating truck and rail loading. Also unloading facilities connected to NGL fractionation, storage, and pipeline assets. They transport and store natural gas through regulated interstate and intrastate natural gas transmission pipelines, as well as natural gas storage facilities. They own and operate a parking garage in Tulsa, Oklahoma, and they lease excess office space and rail cars. Additionally, it transports, stores, and distributes refined products, NGLs, and crude oil, as well as conducts commodity-related activities, including liquids blending, fractionation, and marketing activities. It serves integrated and independent exploration and production companies, NGL and natural gas gathering and processing companies, crude oil and natural gas production companies, utilities, industrial companies, propane distributors, municipalities, ethanol producers, and petrochemical, refining, and NGL marketing companies. They were founded over 100 years ago in 1906, headquartered in Tulsa, Oklahoma. Simply Wall Street's valuation is 91. They say that 23% undervalued. 19 analysts priced this stock at $76. They say it's a little undervalued. Here's their revenue since 2021. It was $8.6 billion. For 2023, it was $19 billion. Projection for 2024 is $24 billion. 2025, $25.5 billion. And 2026, $24.5 billion. Here's their debt since 2013. It was $7 billion. It only increased $1 billion over the next 5 years. Then by 2020, it went up to $14 billion. And then it went down a little over the next few years to $12.7 billion. But with the Magellan acquisition, it went way up to $22 billion. And you can see their equity always trails their debt. So their debt to equity ratio is 134%. That means their debt is 135% of their equity. And this green line is their cash. They keep very little cash on their balance sheet. Currently $284 million. Their ex-dividend date is 129. So you have to own the stock on 128 or before to get to the next dividend. The next dividend is February 14th. Here's their yield since 2014. It was 2.6%. Then it went up to 9.5% by 2015, down to 5% by 2019, and the stock started crashing in 2020, so the yield went up to 13%. It's currently at 5.8%. The forecast for 2026 is 6.1%. The CEO's salary is $800,000, total compensation $8 million. His tenure as CEO is 2.6 years. In the past year, 2 insider buys, 1 sell. 68% of the company is held by institutions and 31% by the general public. The Pennsylvania company Vanguard, with $7.7 trillion of assets under management, owns 10% of the stock. The California company BlackRock owns 8.75%. The Boston, Massachusetts company State Street owns 6 2/3%. They have $4 trillion of assets under management. The Boston, Massachusetts company Geode, with $1 trillion of assets under management, has 2% of the stock. Reef is headquartered in Chicago, Illinois. They own 2%. Lots of big companies own the stock: Morgan Stanley, Invesco, BNY Mellon, Kanye West, Capital Advisors. Their employee count was 1,900 in 2013, 3,000 in 2022. The ticker trades on the New York Stock Exchange, Deutsche Börse, Xetra, London Stock Exchange, Euro TLX, Wiener Börse, and Sao Paulo Bolsa. So let me know what you think. Give the video a like, subscribe, or comment below. If you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.